This video is for entertainment only, reflects the creator's opinions, may include stocks they own, and is not financial advice.
Microsoft spent $116 billion in a single year and watched its free cash flow go backwards. Welcome back to Wall Street Holic, where we cut through the market noise and deliver sharp, data-driven insights without the hype, bias, or distractions. Just clear facts, deep research, and actionable analysis to help you make smarter investment decisions. Every insight is backed by real data, and if you want to dive even deeper, you can download the full research-packed report using the link in the description below. Price at valuation: $455.78 on the 30th of July 2026, up 16.71% in one session after results, still 17.5% below the September 2025 high. This is research and education, not personalized financial advice. So let's start where every good argument starts, by agreeing on what we're actually arguing about. This is a full and comprehensive breakdown on Microsoft's last price evaluation and how we come to a data-driven valuation without the noise. Download the entire research from the link in the description below. 7 chapters in order. What Microsoft actually is now. What financial year 2026 really cost. How big the prize is. Whether Azure is winning. What breaks the thesis. What has to go right. And what the share price is worth. Stay for that last one, because the 6 methods we run disagree by an uncomfortable margin. 3 questions, 1 answer each. 1, is that $116 billion building program earning its cost of capital or quietly destroying it? 2, is Azure genuinely taking share or just renting revenue from one very large customer? 3, at today's price, how much of the good news has the market already paid for? Answer those and you can read any AI era balance sheet on the market. The setup. Before arguing about what a company is worth, you have to agree on what it is. And Microsoft has quietly stopped being a software business. It is now an infrastructure company wearing a software company's multiple. Financial year 2026 revenue, $331.8 billion, up 18%. Operating income, $155.2 billion, up 21%. 3 segments: Office, Windows Software, and LinkedIn at $140 billion. Intelligent Cloud, which is Azure, at $137.8 billion, and hardware at $54.1 billion, shrinking. But look past the revenue split, because on profit, the picture is far more lopsided. Here it is. Office earns a 59.9% operating margin, the share of every sales dollar left after running the business, and 60% is near the ceiling at this size. Intelligent Cloud earns 41.3%, and it slipped even while growing 30%. So Microsoft is funneling cash from a 60% margin business into a 41% margin one. Whether that is value creation or value transfer is the entire argument of this video. Financial year 2026 in 4 quarters. October, OpenAI recapitalizes. Microsoft's stake valued near $135 billion. January, the stock falls 10% on an earnings beat. Read that again, a beat. April, the backlog doubles. And underneath it all, quarterly capital spending going from $17.1 billion to $35.8 billion. Every other number in this analysis is downstream of that one decision. Growth. Product by product. Azure up 43% against 39 to 40% guided. Consumer Cloud up 24%. Then the other half of the company, Windows down 7%, Xbox down 10%. Copilot past 30 million paid seats, and the backlog at $678 billion. Demand that has been signed is a very different animal from demand that is merely hoped for. The numbers: record revenue, record operating profit, record margin, and free cash flow that went backwards. Those 4 things don't normally happen in the same year, so let's find out how they did. Every income statement line hit a record. Revenue $331.8 billion, up 17.8%. Net income $133.7 billion, up 31.4%. Operating margin 46.8%, the highest ever. Then the cash flow statement. Operating cash flow grew $46.8 billion. Capital expenditure grew $51.4 billion, and free cash flow fell. records on one page, a reversal on the next, and the gap between them is the whole story. Two lines moving in opposite directions. Operating margin hit that record 46.8%, but gross margin, what's left after the direct cost of delivering the service, fell for a third straight year. That record was bought with cost restraint, not pricing power, which raises the obvious question: how big has that spending actually got? This big. In financial year 2022, Microsoft spent $23.9 billion of capital expenditure to earn $89 billion of operating cash. In financial year 2026, $115.9 billion to earn $182.9 billion. Capital expenditure has gone from 27% of operating cash flow to 63%. Telecom intensity, not software. And the guidance cut everyone cheered today, largely an accounting reclassification. So where exactly did the cash go? Follow the bridge. Net income, $133.7 billion, add back depreciation, and you reach $182.9 billion of operating cash. Take off capital expenditure and you have $67 billion of free cash flow, the money actually available for dividends and buybacks. Microsoft returned 73% of it. 2 years ago, half that. The dividend is safe, but safe and comfortable are not the same word. This entire valuation pack is available to download in the link below. And this decides the stock. Return on invested capital is the profit earned on every dollar tied up in the business. Cost of capital is what investors demand to leave it there. Microsoft earns 35.9% against 10.2%. Elite. But on new capital added this year, the return was 16.9%, above the hurdle, so the build creates value, and less than half the base, so every dollar drags the average down. That single gap explains this year's D-rating better than any headline written about it. Solvency is not the risk here. $76.8 billion of cash against $40.3 billion of debt gives net cash of $36.5 billion. Every borrowing repayable tomorrow with change. But watch the line underneath. Other long-term liabilities rose $19.9 billion, largely data center leases sitting outside headline debt. Reported gearing flatters what this company has actually committed itself to. Microsoft spent $22.3 billion buying back its own shares last year. It retired 0.09% of the share count. Almost all of it offset stock handed to employees. So treat this as a dilution offset, not compounding value. True shareholder yield is under 1%, which means the whole case rests on the share price. So let's see what the share price has done. 5 years, 3 regimes. 2021 into 2022. Down 36% as interest rates repriced every long-duration asset on Earth. Nothing to do with Microsoft. 2023 to 2025, up 139% to $555, the designated winner of enterprise AI. Then 2026, down 37%. Across those 5 years, the business outgrew the stock, and every bit of that gap is the multiple. Zoom into 12 months, and it is brutal. A high of $552, a low of $349, a 30% rally, and today up 16.71%. Here is the detail that matters. The options market priced a 7% earnings move. It got double that. When positioning is wrong by a factor of 2, price discovery doesn't finish in one afternoon. The prize. Cloud infrastructure is growing 35% a year at a $500 billion run rate, which sounds like justification enough. But the question was never whether the market is big, it is how much of it Microsoft can hold. The total cloud market is put at $752 billion for 2026. Infrastructure services near $516 billion. Microsoft's 21% share, about $108 billion. Read a total addressable market as a ceiling, never a forecast. Nobody wins all of one. Direction matters more. 9 straight quarters of acceleration. Right now, the binding constraint in this industry is not demand. It is concrete. Remaining performance obligation is revenue customers have signed for, but Microsoft hasn't delivered. The backlog. It went from $392 billion to $678 billion in 3 quarters, twice annual revenue, which is the strongest evidence the spending is demand-led. And the discount, One customer, OpenAI, committed $250 billion of it. Concentration on that scale is a risk wearing a moat's clothing. The battlefield. Azure growing 43% at a $100 billion run rate sounds decisive, and acceleration at that size is genuinely rare, but growth only counts as winning if somebody else is losing, so let's check the scoreboard. Latest reported quarters, which don't align perfectly, so read this as a snapshot. AWS, 28% share, growing 19%. Azure, 21%, growing 43%. Google Cloud, 14%, growing 63%. So Azure is taking share and AWS is ceding it. But Azure isn't the growth leader, Google is. Any bull case built on Azure is winning the cloud has to survive that sentence first. Price to earnings is what you pay for $1 of annual profit. 25 times means 25 years of today's earnings at today's price. Microsoft trades at 25.4 against a peer median of 26, Apple at 41, Alphabet at 16.6. Its own 5-year average is 32. Earnings grew 32% while the multiple fell 34%, so the 12-month decline was re-rating, not failure. A moat is whatever stops a competitor taking your customers profitably. Microsoft's is the enterprise contract. Identity, Office, Windows, and Azure sold as one estate, where ripping out the login alone takes years. But model differentiation grades low. It licenses the intelligence. Its moat is the plumbing rather than the brain, and that is a strength and a ceiling at once. What could go wrong? 5 risks ranked by severity, and for each, the number that warns you first. Because the useful question is never, what if I'm wrong? It is, how would I find out early? Ranked. 1. Critical. Capital expenditure outruns monetization. Spending stays near $116 billion while Azure normalizes, and the incremental return falls through the hurdle. 2. Azure decelerates below 30%. 3. OpenAI concentration. 4. A live UK investigation into Copilot bundling. 5. Model commoditization. Notice what is absent. With $36.5 billion of net cash, there is no balance sheet risk here at all. Now with probabilities attached, analyst judgment, not market implied, stated as numbers so you can disagree with a specific one. Capital expenditure outrunning monetization, 30%. Azure below 30% growth, 35%. OpenAI concentration, 25%. Copilot regulation, 40%. Model commoditization, 55%, though capped. Recompute that incremental return each quarter, because 2 quarters trending toward 12% changes everything. The bear isn't saying Microsoft is a bad business. The bear says it has become a different business, and the market still uses the old template. Azure fading to the mid-teens, margin near 42%, a re-rating to 18 times, an infrastructure multiple. Their best evidence. Management guides free cash flow merely to stay positive. When $133 billion of net income makes positive cash flow worth guiding to, the bear has a point. What has to go right? The bull case isn't a hope or a vibe. It is a sequence of measurable, dated events, and the striking thing is how little management has to do for it to work. 5 steps. Capacity fills, so the backlog converts and Azure holds above 40%. Capital intensity peaks. Free cash flow inflects $67 billion to $188 billion by financial year 2031. Copilot revenue per seat gets disclosed. The multiple re-rates. Notice the mechanism. Capital expenditure never falls, revenue grows into it. Probability assigned is 25%, and the trigger to upgrade is 2 straight quarters of incremental returns above 20%. 18 months of catalysts, 3 of them binary, late October, financial year 2027 first quarter, the first test of that 45% Azure guide. January 2027, diarize this one. Calendar 2027 capital expenditure guidance, the number behind every large move in this stock. Dated catalysts matter because they are the moments the market is forced to reprice, ready or not. So what's the actual share price value? 7 key evidence points, 1 question left. So what is Microsoft actually worth? So, what a discounted cash flow really does, you estimate the cash a business throws off every year into the future, then mark each year down, because a dollar arriving in 2036 is worth less to you than a dollar in your hand today. It prices tomorrow's money in today's terms. And every assumption is on the table, from 15% growth to a 10.2% discount rate. And 62% of the answer sits beyond financial year 2036, which is why the next two slides matter more than the point estimate. This chart is the model's entire argument. Capital expenditure never falls. It sits near $120 billion for a decade. What changes is the denominator. Revenue grows 2.5 times while spending stays flat, so intensity collapses without anyone announcing a cut. That is a deliberately conservative construction, so why is the answer still so unstable? Because of this. Move the discount rate 1 percentage point, and the answer moves 25%. The grid runs from $303 a share to $517, and today's price sits inside it. To justify today, you need perpetual growth above 4%, faster than the economy grows. That isn't absurd, but it is more optimistic than the base case in front of you. 6 methods, disagreeing by 127%. Bare discounted cash flow, $243. Base, $380. Peer multiples, $467. Bull discounted cash flow, $508. Street consensus, $551. Why can't they agree? A discounted cash flow charges capital spending against value the year it's spent. A price-to-earnings multiple never sees capital expenditure at all. The dispersion is not a flaw in the analysis. The dispersion is the analysis. So blend them. Bare, 25%. Azure fades, the multiple re-rates to 18 times, $285. Base, 50%. Intensity halves, 24 times exit, $420. Bull, 25%. Capacity fills, 29 times, $545. Probability weight all three, and you get $417.50, or 8.4% below today's price. Note the spread though, 57% of the price, which is a position sizing instruction rather than a footnote. And here is the reassuring part. Those three futures separate by $177 billion by financial year 2031. More than Microsoft's entire cloud segment today, but even the bear case compounds revenue at 7.1% a year. The downside here is a de-rating rather than an impairment, and those are very different things to live through. 3 prices. The no-brainer level, $160, net cash plus 14 times the legacy software annuity, assigning the AI build a value of 0. It has never traded there. Its job is to show where the floor really is. Intrinsic, $420. High case, $545. So the market is paying for a meaningful slice of the bull case, but not all of it. The 7 numbers at a glance. Price at valuation, $455.78. Intrinsic value, $420. Bear, $285. Bull, $545. Probability weighted value, $417.50. And confidence, medium, because the methods disagree by 127%, and because Azure's dollar revenue and Copilot's revenue per seat are never disclosed. Which brings us to the verdict, and it is rather less exciting than either camp would like. Fairly valued, confidence medium, Microsoft is an exceptional business deploying enormous capital at returns that clear its cost of capital, but sit at half its historical base. At $455.78, the weighted value is 8.4% below, not a short, a fully valued mega cap where weighting beats chasing, and that is precisely the kind of setup the options market was built for. Implied volatility is the market's forecast of how much a stock will move, and it sets the price of every option. Buy it high and you overpay for movement. Buy it low and you get that movement cheap. Microsoft sits at 17%. The stock actually delivered 35.4%, the bottom of its range, because the crush already happened. So the premium seller has just missed their window, and the premium buyer has walked into theirs. 3 structures. Cash secured put, January 2027, $400 strike, wait for the October volatility ramp, leap call, January 2028, $440 strike, Preferred, 18 months of duration at half the realized volatility. And the standing reminder, options decay, they can lose value fast, and they are not for everyone. Who this suits? Long horizon holders measuring in years, core quality portfolios, anyone prepared to add lower. Who it doesn't? Income investors with the yield under 1%, anyone needing capital back inside a year, and anyone who couldn't sit through a 37% drawdown. Matching a stock to your own situation matters far more than whether the company is any good. 3 horizons, long-term, positive, franchise, backlog, and 35.9% returns intact. Medium-term, neutral, financial year 2027 is the trough year. Short-term, cautious, that gap is unfilled. Fundamentals 8 out of 10, technicals 6. And the line worth repeating, there's no edge in the direction, it's in the volatility, which is why the trade here is the structure rather than the share. Don't forget to download the entire analysis from the link in the description below. So, the thesis. Microsoft is an elite business spending unprecedented sums at returns that clear its cost of capital, but no longer match its history. The market has already repriced it 30% off the June low, leaving it fairly valued rather than cheap. Own it if you already do. Require a better price to add. Everything here is research and education, not personalized financial advice. It takes no account of your circumstances, tax position, or risk tolerance, and figures are as at the 30th of July 2026, with the price live intraday, so verify before acting. Options carry a risk of total loss. Speak to a licensed professional first. And notice what this one did not do. It never hid behind a confident-sounding headline, and it gave the bear exactly the same airtime as the bull. At Wall Street Holic, we ignore the hype and follow the same disciplined, data-driven process, being transparent about what we know, what we don't, and where the evidence leads. Don't forget to download your copy of the full research in this video using the link in the description below. If you want to cut through the noise, hit subscribe, give the video a like, and share it with others. This is a subscriber-led channel, so the more requests we receive, the more in-depth research and deep dives we bring to you. See you in the next video.
This video is for entertainment only, reflects the creator's opinions, may include stocks they own, and is not financial advice.